everyone. Welcome today. My name is Daharsh. My colleague Larissa Greene and I are here to put on this educational webinar about using your IRA as a down payment on real estate. That is going to be today's topic. So it's real estate aligned. It's also lending aligned. We're going to talk about different ways that this strategy works, ways that it doesn't work, and hopefully clear the air on this very common question and topic that we are asked about. Again, your presenters today are myself, Daharsh, Business Development Specialist with Advanta IRA, and my colleague Larissa Greene, Director of Education and Business Development Specialist with Advanta IRA. We've both been with the company, Larissa over 10 years, myself closing in on the back end of I guess I'm at 7 years now. You can reach either of us by using the contact information listed here. Larissa, thank you very much for joining me and partnering on this webinar today. Anything you'd like to share with the audience, either about your background or other educational opportunities that we provide out to them?
Thank you, Corey. Thanks for having me today. I'm excited to talk about this. As Corey mentioned, this is a very common question that we get, and so we're always happy to put webinars together based around questions that we have asked. And even if you have a topic that you're wondering if we could maybe cover for educational purposes on self-directed retirement accounts, we'd be happy to do so. Please feel free to reach out to us. Corey and I both have extensive backgrounds in self-directed retirement accounts. Like Corey said, he's going on 7 years. I'm almost at my 12-year mark with Advanta, but both of us started out doing different things here at Advanta IRA. So we have a lot of experience with things like, for example, Corey did a lot of transactions. He used to be an account manager. If you're a client on the call, you might have had Corey help you with a transaction in the past. I did new accounts and check coding. I did some transactions and transfers, things of that nature. So we both have a lot of experience in the self-directed IRA space. And so that is really where we're sort of coming from. And again, this is a question that we get asked a lot. And so we have seen transactions on all ends of the spectrum, and that includes IRAs as down payments. Thank you, Corey.
Yep, thanks, Larissa. And a little bit of housekeeping for the webinar today. We are going to keep the attendees muted so that Larissa and I can give the presentation. Having said that, we do want participation from you guys that are attending live with us today. So the way we handle participation with these educational webinars, you have a question box in your GoToWebinar panel. Go ahead and type any questions you have, and we will review and assess those as we go. Anything relevant to the topic today that we don't get to in the middle of the presentation, we will cover at a session towards the end when we do a wrap-up Q&A and conclusion. I see people have intermittently used the hand raise button. Again, we're not going to unmute the audience today. So please turn your attention to the questions box. Also, if you're looking for a copy of the slide deck today, we do have that uploaded into the handout section, so you can download the PDF of today's slides, or you can reach out to Larissa or I directly after the webinar via email or phone call, and we'd be happy to share with you a copy of today's slide deck. So just so everyone's on the same page, we're going to go ahead and move forward now with some basic information about Advanta, and then we'll get into the brunt of the educational components. So Advanta IRA is a self-directed retirement account administrator that have been in business for 20 years now. In 2023, we've hit our 20-year mark. We've got just about 10,000 active clients and just over $2.3 billion in assets under management. All of the funds that our clients hold that are not actively invested are insured up to FDIC limits in accounts labeled as uninvested cash or undirected funds that you have access to move wherever and however you want to from a self-directed investing standpoint. And again, as Larissa referenced, each client that we have is paired with a dedicated client account manager that's going to be your go-to concierge level person that helps you with any questions you have, investments you'd like to process, IRS rules or regulations you'd like to review. I spent about 5 years in that role, and it really helped me build a knowledge base of not only today's topic, but several other topics related to self-directed investing. So you will have a dedicated person that's going to be an expert in retirement account investments, that's going to be able to hold your hand through whatever interests you have in investments you'd like to process. Now, as a disclaimer for what we do not provide at Advanta IRA, we simply do not provide tax, legal, or financial advice. Our information today is strictly for educational purposes. So everything Larissa and I are going to describe to you and the case studies we're going to share with you are going to be rounded numbers. It's going to be for educational. It's not real life scenarios or real life events in our case studies. And we always implore you to do your own due diligence before entering any investment strategy or partaking in any specific opportunity you may hear about. Speaking about hearing about things in this world, if you are just now hearing about self-directed investing for the first time, don't feel like you're late to the game or that you've missed out for too long on anything. Only about 4% of US-based retirement accounts are self-directed right now. In the grand scheme of things, that industry in itself is hovering around $40 trillion. So again, only about 1.5 billion or 1.5 trillion of the 40 trillion in US-based retirement accounts are being self-directed. So a lot of the push that we try to do at Advanta IRA is just educating people that these opportunities even exist, and then again, letting them take their own discretion and make their own investments aside from what a stockbroker or financial advisor is telling you you should invest into. You should be making those decisions yourself. There are a number of different plans that can be self-directed. Most people are familiar with your traditional and Roth IRA plans, or maybe you have an employer-sponsored plan. But once you leave an employer, you're actually eligible to roll over those employer-sponsored plans like 401ks, 403bs, 457s, and thrift savings plans into a self-directed IRA account. For small business owners, we offer individual 401k plans and SEP and simple IRA plans that could fit your needs as a small business owner. And we also allow you to self-direct health savings and education savings accounts if you're interested in setting aside money for your health expenses, if you're someone that has a high deductible health policy, or for your children's educational expenses. And again, those are great ways to self-direct those funds and really utilize your unique investment goals to benefit these savings for your children's expenses, for your own health expenses or your family's health expenses, and then your general nest egg for retirement later in life as well. I do see the first question pop up relative to my last slide there, so I'm going to address this real quick. Does FDIC insured cash held in the account pay a rate of return? The answer is no. The money that a client has sitting in an Advanta account not actively invested does not bear any interest. So it is completely up to you as the self-direct account holder to decide how much money you're comfortable leaving idle versus maybe keeping a diversification strategy going where you have a managed account with another custodian, and you can go ahead and decide where and how you're going to assess the money in that capacity. Larissa, do you want to jump on for the next slide there?
Yes. The different types of investments that we see at Advanta IRA, they are really sort of all over the board, but real estate investments tend to be the #1 investment we see. And so a lot of times you'll see, if you go to our webinar library on our YouTube channel, or if you check it out on our website, you're going to see a lot of our webinars are based around real estate. And so that's why you guys are all joining us today to hear a little bit about real estate investments. And so we sort of like to go over the different strategies that are allowed or that we see commonly in a self-directed IRA, but actually the IRS has not given us a list of investments that you can make. Instead, what they've done is given us a very, very short list of investments that you can't make, as well as some people that you can't invest with or people that can't have a current benefit from your investments. And so just about the sky is the limit when it comes to self-directed retirement accounts. So that being said, this is really just to give you an idea of what we're seeing pretty regularly at Advanta IRA. But if you have an idea for an investment strategy when it comes to real estate or really just about anything, please feel free to reach out to us to find out how that might work within your self-directed IRA. And we can tell you a little bit about how the rules work and how those structures may or may not work for you. But of course, the first investment very simply is going to be a long-term single-family home. That is the most common investment that we see at Advanta IRA. So people purchase 123 Main Street, with their retirement account. They put a long-term tenant in that house and they receive rental income back to their retirement account. But it could also be short-term rentals. You can do rehab projects in your IRA. You can invest in condos. And sometimes those condos are, in a rental pool. So a short-term rental where it's managed by some third party where they put people into those condos. We've seen that done, vacation rentals, mobile homes and mobile home parks. So there's no specific requirement for it to be, a single family home, for example. It certainly could be a mobile home or a mobile home park, or a syndication into something like mobile home parks and multifamily real estate. That is absolutely something we see pretty regularly. We have seen people bidding on tax deeds at auction. And then, of course, tax liens as well, and real estate investment trusts. So I know some REITs are considered publicly traded, and those we do not hold, but anything privately traded we can certainly hold. And so the list really truly does go on, but this will give you an idea of what we see very regularly at Advanta.
And Larissa, before jumping into the next slide, a few questions came up that are pretty relevant to the asset classes. Someone asked, seems like a newer investor, if we have a list of investment possibilities for someone starting out, and then also any typical minimums. So the person referenced that they've made a $50,000, what I believe to be a syndication investment with a real estate deal, and they've got some residual cash left behind. Do you just want to express to the audience what this person's scenario is and what Advanta's role is in the grand scheme?
Yep, absolutely. So those are great questions. We do not have a list of investments, but again, these webinars are really to help you understand what investments that we're seeing at Advanta IRA and maybe give you an idea of investments that you can make through a self-directed account. So if you have money left over and you're looking for an investment, someplace to put that money, it's really up to you to wear your entrepreneurial hat here and find an investment for it. But hopefully by joining webinars like these, you'll get some ideas for investments that you might want to make through your account. And also, when you have money left over, this is the exact type of scenario we're going to be talking about, where Corey and I are going to discuss how to use your IRA as maybe a down payment towards real estate, or put it to work with other people's capital in order to make those investments. So hopefully you'll really see a structure in this webinar that will help you understand what possibilities there are out there. And of course, if you're looking for something that is not real estate based, I did a webinar probably about a month and a half ago where we talk about what to do with your leftover cash. And so we talked about different investments outside of real estate where you can put that money in. Again, just to give you ideas and talk about the structures of those investments as well. So if you're interested in that, just feel free to shoot me an email and we can talk about that, and I can get you the link to that webinar. So self-directed IRA rules, remember we talked about how there are some investments that you can't make and some people you can't invest with, or some people that can't have a current benefit from your IRA investment. So these are those disqualified persons, and that's how the IRS kind of has labeled them. So disqualified persons would be the IRA holder. So again, you can't transact with yourself, no self-dealing, with your spouse, and then parents or grandparents, children, grandchildren, and then spouses or business entities of those. So when you're looking at this slide, you'll see here where we're really kind of saying anybody up and down your lineal tree would be considered a disqualified individual or disqualified persons from dealing with your IRA or having a current benefit. And so when you're making investments, you want to be careful about that. Typically what I would say is anything that is considered arm's length, something new to you and new to your IRA, and then also an investment for investment purposes. So keeping that in mind, if you were going to lend money to your son or daughter, for example, from your IRA, that's probably not an investment for investment purposes and is also prohibited because they are considered disqualified persons. So other people can be considered disqualified. And just keeping in mind that these disqualified persons cannot have a current benefit from your IRA. So if you said, well, you know what, my son works for this company, it's an up and coming company, they're raising capital to expand and I want to invest in that company. But when I make that investment, then that is going to give my son the opportunity to sit on the board, or he's going to get a promotion. Now there is a current benefit to your son for that investment. And so that would be something that would be considered prohibited.
And Larissa, again, real quick before you jump on to the next thing, it just, funnily enough, the last thing you mentioned actually relates to a new question that came in. I'll address this one. It says, for multifamily syndication, is there any way for a co-GP to use their self-directed IRA funds for the investment? And the reason I thought that was funny is because it relates very similarly to Larissa's last example with that son that may be on the GP team and you as a parent investing your retirement dollars into that syndication. So there's a rule there, obviously with the son, that they can't receive a current benefit. But if you are the GP, so let's replace the son with you yourself, the same rule does apply. If you are on the GP side of the deal in a syndication, you really should not, in 99% of scenarios, be considering using your retirement dollars. And the IRS's rules there indicate that your retirement funds cannot have a current benefit to your future self or a future benefit to your current self. So you using retirement dollars on a deal that you're a general partner of could be seen as a disqualified item. If you're making day-to-day decisions as a GP, if you own 50% or more of the deal as a GP, then you really should not be using your retirement dollars. If those two factors do not apply, feel free to consult your own legal guidance or compliance with a legal professional that can give you their expertise and feedback. Again, Larissa and I cannot give legal, tax, or financial advice. So ideally, you're not using funds in a deal that you're a co-GP on. If the scenarios I outlined would apply or would not apply, then determine if it's best for you to consult a proper legal professional for that.
Yeah, exactly right. Exactly, Corey. So we had a follow-up question pop up to that. What if you're a real estate professional? I think I probably need some more context there, but just for your information, if you are a real estate professional, a full-time investor, you are categorized by the IRS as a real estate professional. I don't know that necessarily comes into play as far as whether or not you can make investments again, as long as investments are new to you and new to the IRA, and you're not buying or transacting with those individuals considered disqualified, then that might be okay still, but you can't pay yourself a salary or anything like that. Again, no current benefit. And if you can make decisions for the IRA account, but if at some point you feel like you're providing sweat equity to the IRA-owned investment, then that would be considered prohibited. There are some things that are very clear here and some things that become a gray area and we just don't have clarification on. And so, for example, if you're looking for a property and you want to walk the property and make sure that, this is the investment that you want to make, then, that's probably okay. I would think that the IRS wouldn't have a problem with you making sure that this is the property that you want to purchase and doing your due diligence on that investment. But for example, if you wanted to go once the property is purchased and mow the lawn and paint the front door red, then those things are going to be considered providing sweat equity and prohibited. So that wouldn't be sweat equity that you could provide or any of those disqualified persons. If you are a real estate agent and you're asking on that end of the spectrum, it's probably better to have another real estate agent friend work for your IRA rather than providing those services to your IRA directly. If you buy the property in an LLC, the LLC does not circumvent the rules. So the rules are still going to apply here. And so you want to keep that in mind. So anytime you invest through an LLC, and actually Corey will be talking about using an LLC here shortly, anytime you invest through an LLC, you want to make sure that you understand the rules and that you're still abiding by them, because having checkbook control could make it easier for you to engage in something that would be considered a prohibited transaction. There was another question that popped up on LLCs, but I'm going to save that because I think that Corey is going to cover that when we get to that portion. So we're going to redirect our attention here to how you can use your IRA as a down payment. And as we said in the very beginning of this webinar, this is one of the most common questions that we get, and similarly to the attendee that asked about, some funds left over in their retirement account, a lot of times people will say, well, I have an old employer plan and it's just sitting and I want to move it over to make investments, but there's not enough to buy a property, but I'm going to use it as a down payment. Well, you certainly can do that. There is a way to do that, But this is an investment for the retirement account, not an investment for you personally. And that is something that you want to keep in mind here, because a lot of times people want to take that money. Let's say you have $25,000, $35,000 in an old employer plan and you want to use that as a down payment. A lot of times people are thinking, okay, well, I'll take that money, use it as a down payment. I'll go out and get a loan. I'll pay the loan and I'll pay the IRA back once I have enough income from the property to do so. And that isn't going to work. That structure won't work for your IRA account, but there are ways to structure this deal so that you can make it work within the IRA. And so that's what you do want to keep in mind when you're looking at using this strategy. So here are the things that you need to know if you're going to use this strategy. So the IRA holds title. It's not an investment, a personal investment for you. As I mentioned, it is an investment of the IRA. So we're going to give you that specific titling, and then everything, including the loan, must be titled for the IRA. So Advanta IRA for benefit of John Smith IRA number 1234. The IRA is going to hold title here. The IRA is going to get the loan and make the loan payments. That's very, very important here. And then income is received by the IRA, and the IRA is paying all expenses for that property. So again, the structure where you're thinking, okay, well, I'll put the money down, but then I'll take care of the property, it'll be in my name, I'll pay the IRA back later. That isn't going to work. But if the IRA is going to put the down payment down, then it can get the loan, receive the income, pay the expenses, and that includes the loan payment. The next part of that is that this loan has to be a non-recourse loan. So when you're investing in real estate using financing, the IRA must obtain the loan and the loan must be non-recourse. You're typically going to see it a few points higher than whatever fair market interest rate is. You're going to see that you cannot extend your personal credit or give a personal guarantee for this loan. That is what a non-recourse loan is. There are some institutional lenders that will do non-recourse loans. As a matter of fact, there are a few out there that have made their whole business around lending to retirement accounts. There's going to be many private money lenders. This can even be seller financing, for example, but it has to be considered non-recourse. That is very important. You're typically with the institutional lenders going to see that you have to put a little more down. So this would normally be a scenario where you would see like 10% down, for example, or at least not through institutional lenders. You can Google IRA loans or IRA lenders and you will find those institutional lenders out there. Corey and I can also provide you with a list. And again, sometimes private money will work. You could always check with your local bank or credit union to find out if they will do non-recourse loans. Every once in a while, we do come across another one that somebody has a banking relationship with that will do this type of loan. And then the last moving part to this strategy is unrelated business income tax. And this tax, it applies only really 2 times in an IRA. So typically an IRA grows tax deferred or tax free, of course, just as you would expect it to. The whole purpose of is going to be to keep the tax status of the retirement account typically when you're making investments. But when you're looking at something where you're going to purchase real estate using financing, you are going to expose the IRA to a tax called unrelated business income tax or unrelated debt financed income tax. And so the unrelated debt financed income is going to trigger unrelated business income tax. And I said there was only 2 times that the IRA would incur a tax, and the other one is for business income. And I'm not going to talk about that here today, but those are the 2 times when you're purchasing with financing and when the IRA gets business income. And of course, typically an IRA is going to receive passive income. So today we're going to focus on financing. So I have an example of what that looks like, but basically this tax is on the income related to the debt. So if you borrow 50%, then 50% of the income is going to be taxable, and it is taxed at trust tax rate. So it's the highest rate, I think 37 to 39%, something around there. But there are ways to mitigate this tax. So if you're looking at using this strategy, then you could always look to your CPA to help you with mitigating this tax. So a couple things here. One, the IRA would get some deductions here. So typically the IRA, or you personally, you do not get deductions for IRA expenses and IRA investments, but in this case, the IRA would get some deductions. You could potentially use like a C Corp to change the taxation on the investment itself. So of course the C Corp gets taxed at the corporate level, and so that might help you offset some of this tax. And then if you are self-employed and making contributions to a solo 401k, or you have a 401k that will work with a self-directed account, then the 401k this tax does not apply when you're purchasing using financing. So that is those are different ways that you can mitigate this tax. And if you have more questions, please let us know. But also talk to your CPA about this before putting this structure together. The IRA does have to file an additional form every year called a 990T to report and pay the tax. And again, this is an expense to the retirement account. So you want to make sure when you're putting these strategies together, the structure together, that your IRA can afford to also pay this tax.
All right, before I jump into this slide, I just want to let our audience know real quickly a few of the things that Larissa covered on the last slide. We have covered in depth in their own webinars. Larissa, we're jumping ahead.
Yeah, sorry about that. Okay. Go ahead.
So we've done a webinar specifically on UBIT and UDFI tax, multiple for that matter, that you could find on our YouTube page. And I've also done a webinar with an institutional non-recourse lender, Bob Cash, that you can find on our YouTube page as well. So if you're interested specifically in either of those topics in more depth, go ahead and check those out on our YouTube page, Advanta IRA on YouTube. But jumping back into the topic at hand here, when you're talking about using an IRA as a down payment on real estate, a lot of people simply think, oh, I can pull money or borrow against my retirement account for a property I'm purchasing personally. And that is part of the misnomer that we're here to clarify with you guys. That's also something that, again, there's different ways around what you're doing to invest the money versus what's actually allowed and what you're trying to do. So again, expectation versus reality here. Partnering your retirement funds, as Larissa covered, as long as it's not with disqualified persons rules, you're fine to do that. Whether you're partnering with yourself, you're partnering with a disqualified person. As long as you're not buying the property from the disqualified person, those deal structures would work. And the other way that you can really use your retirement dollars as a down payment on property is by acquiring lending, buying the property 100% in the retirement account while utilizing leverage. So there's pros and cons for each. Again, you're giving up either some ownership control and ownership stake in the deal, or you're utilizing leveraging and having to pay the UBIT or UDFI tax relative to the portion that's being leveraged. So what I'm going to specifically cover here in the next few slides is ways to partner together, specifically either joint venturing or using an LLC when you're partnering on deals. And then after I cover that information, Larissa is going to cover a case study on utilizing the leverage and breaking down some of the more detailed information about that UDFI structure. So when you're considering joint venturing, you need to decide who is bringing what to the table. As Larissa mentioned, and we will reiterate again, you can't provide sweat equity if you're using retirement dollars in a deal. So typically that renders you, and or by extension your retirement account as the investor, simply as the cash opportunist here. You're bringing the cash to the table, and your partner is either also bringing cash and or bringing sweat equity to the deal if anything is required. If you're talking about a fix and flip project, or you're talking about self-managing a rental property, so someone's going to need to do some maintenance, some cleaning, some rehab work, that can all be done by your partner, but not necessarily by yourself if your retirement dollars are being utilized. How will the costs be handled and the profits be split? As Larissa referenced in the case study or example of case study with non-recourse lending, that's all needing to be split based on the ownership percentage or the percentage of the loan. That same principle applies here in that any joint venture, if the property deed of title lists 50%, 50%, 75, 25, whatever the percentage is, the income and the cost of the property have to be split at that percentage. And then as an self-directed or solo K investor, you control the terms of this joint venture agreement. So again, you set the precedent for, I'm bringing X dollars to the table. My partner here may not be bringing X dollars, but they're going to bring Y committed sweat equity or whatever else it may be. And that's completely up to you and your partner to draft those terms, whether you go to an attorney and have it drafted legally, or you work together to just come up with something amicable. There's no real hard and fast rule from the IRS here as to what the status or specific details in that joint venture agreement would be. It's up to you to determine them and make sure you apply them moving forward with the strategy. So again, when you're looking at just basics of these strategies, the IRA can only receive income on behalf of the part that it owns. Paying expenses has to be split based on the same percentages. So the IRA can only push out funds for expenses relative to the percentage of its ownership. The tenants must pay the rent, potentially with 2 checks if it's paying 2 different entities. So that is why having maybe an LLC is a little bit more of a favorable option, or even employing a property manager to kind of be a middleman in these scenarios would be a good option for some investors. Partnering with yourself can work, but it may be a gray area. Again, we would like you to seek legal advice if you're looking at partnering your retirement account as the down payment component with yourself personally as the other investor in a deal. So let's just say you've got a $100,000 property and you want to put $20,000 of IRA money into the deal and $80,000 out of your personal pocket. Yes, it's allowed. We just want you to seek legal advice to make sure you understand what you plan to do in the long run with that deal, and make sure there's nothing in your grand scheme of investment strategy that conflicts with those prohibited rules. You can not add disqualified persons to the investment after the purchase. Again, that's something that has to be set at the outset of the investment, where you're partnering with disqualified persons, but you cannot add them later in any context of the deal. And remember, you can never sit on the opposite side of the deal from a disqualified person. In other words, buy property from a disqualified person. Let a disqualified person rent a property you own using retirement dollars. Those are kind of the ways that the IRS looks at those rules. Again, reach out to Larissa or I if you have further questions or need any assistance with those rules.
And we had a couple questions pop up right around that too, Corey. So the first question is, can your partner be your husband? And your partner can be your husband. You can partner IRA funds with disqualified persons, but as Corey just mentioned, you have to do that at the outset. So you have to determine if you're going to bring in a partner that would be considered disqualified at the beginning of this investment, so that upon purchase or upon investment, you are partnering directly into the deal. You can't decide later that you're going to sell a disqualified person a portion of this investment, or their IRA a portion of this investment. And so if you're going to take some money and put it together with your spouse's retirement account, you can do that, just making sure that you're doing it at the outset, and the percentage of ownership is going to be directly related to the amount of funds each IRA or each individual brings to the table in that case. And then once that percentage of ownership is determined, you can't make any changes to that when it comes to disqualified persons. It has to remain that percentage of ownership for the life of the investment. Another question on that was, if my IRA owns rental property, can an entity I own rent that property? And unfortunately, you cannot. So that goes into those self-dealing rules, where that would really be considered self-dealing. So any entity that you own would be prohibited from renting that property, and that includes disqualified persons and any entity that they own as well. And the last question that popped up here, can my investment be made on a property in a different country. Yes, actually, we do have clients invested outside of the US. And so just keeping in mind, and this goes back to, investment and legal advice, making sure you're doing your due diligence. And also, you may have to find out what that country requires in order for you to make that investment. So for example, some of our clients that are invested outside of the US have had to open that country's equivalent of an LLC in order to purchase property in the country that they wanted to invest in. And so we're not going to give you guidance on that. So just make sure that you're understanding what might be required by that country in order to make those investments, and maybe retain some counsel in order to make that investment as well. And we'll certainly help you use the IRA to fund that investment.
And another shameless promotion, Larissa and I earlier this year covered a full webinar on investing your retirement dollars into foreign real estate. So for the person that asked that question, if you want to see an in-depth coverage of that topic, go ahead and check out our YouTube page, Advanta IRA on YouTube, and you can find that webinar where Larissa and I, in a full webinar, covered investing into real estate internationally with your retirement dollars.
Yep, absolutely. And Corey, we also had one more question pop up, and I think this does sometimes happen because of the do's and don'ts. They sound like double negatives because the IRS uses disqualified and non-disqualified individuals. One time somebody said to me, why are they considered non-disqualified and they're not just considered qualified? And I don't have the answer to that, but essentially, in order to just clear it up, if you are investing and you're partnering with somebody up and down your lineal tree, so partnering with a family member, you can do that as long as you're doing it at the outset. So this is a brand new investment to you, a brand new investment to them, and you're going in together on this investment at the time of the investment is allowed. If you are transacting, so somebody up and down your lineal tree, some family member that is considered disqualified, a transaction would be buying it from them, selling it to them, having them act as a property manager, having them provide services to an IRA-owned asset. That would be considered prohibited. So I hope that helps clear up the confusion. So if you're going in together on the investment at the outset, that's okay. Transacting later on or providing sweat equity would be considered prohibited.
All right, we're going to jump back on topic with these next few slides. I see one other question had come in since Larissa was explaining that answer, but let's just get through the next few slides and then we'll readdress the topics or questions coming in from the audience. But do keep them coming. We're happy to address them all. If we don't get them as they relate to our slides as we're going, we will cover a Q&A at the end as well. So just to hone back in, we're talking about a partnering option of setting up an LLC where your retirement account and any other investors own a portion of ownership in an LLC based on the dollar amounts that they contribute into that LLC. And that LLC, in turn, is the entity that's buying the piece of property. So your IRA may be a 20% portion, as I referenced in my 20-80 real estate split earlier, and the other 80% ownership of the LLC is brought together by investor X and investor Y. So that the total in the LLC is set up to purchase the property, do any maintenance or expenses due on the property, and then obviously your intent is to get that property turned around and generating income back into that LLC as soon as possible. The percentage of ownership, as Larissa mentioned, in answering her first question when we switched to this slide, is based on that ownership percentage. Exactly the dollar amount brought to the table is what breaks down the ownership percentage. And once that is set, when the deal is set up, it is locked in stone. If you need more money in that LLC in the future, everyone must contribute an appropriate amount based on their ownership percentage. So if this is a 33% split between these three owners and you need $10,000 more, or let's just say $30,000 more to make it easy, each partner is going to need to bring $10,000 to the table. And if one of the three partners cannot, well, you're technically locked out from those two putting in their money. You've got to find some sort of workaround, maybe utilizing a non-recourse loan to get things up to speed. So it's always important to do your due diligence and make sure your strategy is fully flushed out and lined out so that you don't run out of money in the course of a deal or run too short or too tight with the finances during the actions of the deal. And also, again, be mindful if you're someone that's at required minimum distribution age, that may be coming to play. Your account manager will be able to speak with you about how to utilize RMD rules and how to take your RMDs from various accounts when you know what your RMD or required minimum distribution total is relative to each IRA account you hold. So as I mentioned at the beginning of that slide when I was explaining it, when you partner on real estate through an LLC, the LLC is what's taking title of the property, not the retirement account, not any of the partners in the LLC. It's the LLC as its own entity. So the tax ID number that you'll have on file for the LLC is the tax ID number that's on the deed of title and tied through the ownership of that property. The manager of the LLC will be responsible for cutting all the checks and receiving all the income unless they employ a property manager, which I briefly referenced earlier as well. And the percentage of ownership is how the flow of money out of the LLC goes. So if your partnership wants to take personal funds out of the LLC, and let's say partner A wants to take 10,000 out and it's everyone owns the same percentage, then partner B and partner C are liable to take their 10% or $10,000 out as well for dispersing the money out that the profits have been generated through that LLC and through that property. So we're at a point here for Larissa to cover her case study, and then I will cover a case study after that. Larissa, before we jump into case studies, while we're on a fresh slide, do you want to go back through some of these questions that have come in over the last few slides?
Yes. So the first one here is there a structure that would allow the IRA holder to reside part-time in a property in a vacation rental? And the answer is no. Unfortunately, if the IRA owns 1%, then the IRS considers that the IRA owns 1% of the investment at all times, and it would be considered a prohibited transaction to stay in the vacation rental, unfortunately. So again, it's an investment for investment purposes only.
And the next question I see there is, can IRA purchase property from LLC in which I have a minority interest? Typically, the answer for that would be no. If you wanted to seek legal guidance, the type of questions that a legal professional is going to verify further is, what is your role within that LLC with your minority interest? What percentage are we discussing at minority rate? Are you single digit ownership? Are you double digit but less than 50%? And proper attorney well-versed in these rules and strategies will be able to give you good feedback on that. Again, from Advanta's side, as I referenced earlier, we would lean towards shying away from that investment just because there is a potential conflict of interest or potential red flags to the IRS. But if you are someone that's asking that question that we're really interested in doing that deal and making that deal work, I'm sure you could find a legal professional that'll give you official guidance on whether they sign off and would put a legal letter of opinion together that discloses that you can make that investment or should not make that investment.
Right. And then another one that popped up is, if I use the IRA for a down payment on raw land, can I use the IRA for contract work to enhance or subdivide, i.e. fence building, new survey, and marketing? And the answer is yes. As a matter of fact, those would be considered expenses of the retirement account because that is an investment of the retirement account. So keep in mind that if you are making the investment with an IRA, then the IRA is going to be responsible for any expenses. And again, just making sure that you're hiring all the appropriate professionals here in not providing sweat equity to the IRA owned asset. And some of that is going to be really clear, and then some of it might seem like a little bit of a gray area, and we're happy to talk to you more about that outside of the webinar. Please feel free to reach out to us.
Larissa, real quick before we move on, I just want to add one simple caveat to your answer that we provided on that raw land down payment. Keep in mind, the answer also varies a little bit based on what you're considering the quote down payment. Again, Larissa's side of the down payment strategy today is utilizing non-recourse lending, where your IRA is probably going to be 100% ownership of the property, but taking back borrowing money. So in that context, your IRA would be subject to pay 100% of those expenses referenced for contracting, fence building, etc. But if you're using the other down payment strategy we're discussing today of partnering, then your IRA money should only be used for the portion of ownership either in an LLC or in the property itself, and the other partners should be coming up with the rest of the costs for that contract work and fence building and so forth. So again, Larissa's answer was great. I just wanted to make sure we express the caveat there based on how you're considering this down payment structure for your specific use case.
That's a great point, Corey. That's a really good point. And like I said, if you have more questions on that, please reach out to us. We're happy to go over a specific scenario with you as well. So here is our example case study of using your retirement account as a down payment with financing. So Mike has an old 401k with 160 in it. He finds a house for 150 that doesn't need repair work. But instead of using 100% of his funds here, he decides that he wants to use money as a down payment and get a non-recourse loan so that he can buy 2 properties. So he's basically saying, you know what, instead of using 100% of my cash here, I'd rather use it as a down payment and look for another property down the road. And so here are the details for you: $90,000 loan, 6% fixed rate loan, 30-year amortized, monthly payments are $450, annual payments are $6,500, and that'll be important, you'll see, as we talk about unrelated business income tax. So again, Mike cannot guarantee the note personally, then the bank's only recourse is foreclosure. So keeping that in mind, the loan is directly to the IRA, and the IRA will be repaying the loan directly out of the IRA account. Typically, it's going to be 30 to 40% down, and there is going to be unrelated debt finance income tax or unrelated business income tax on the mortgaged amount, the income related to the mortgaged amount of the property. So if he's only putting, 30% down, then 70% of his income is going to be exposed to this tax, again, directly related. Only the financed portion of the income is going to be subject to this tax. The percent that is going to be exposed obviously decreases every year as the loan is paid down. The IRA does file this additional form, so 990T will be filed every year, and the IRA will pay that tax after deductions and depreciation. And no 990T is necessary if the UDFI liability is less than $1,000. So after calculations, if the IRA owes less than $1,000, then if the debt is less than $1,000, then the 990T does not apply, and tax is paid at trust tax rates. So just keeping that in mind, because it is high. And remember, we talked a little bit about how to mitigate that tax. If you have more questions on that, let us know. And actually, you can find a webinar on unrelated business income tax in our video library and on our YouTube channel, where our partner Alex talks very specifically about unrelated business income tax, and he does talk about ways to mitigate that tax as well. And I think that is a great webinar if you're considering this strategy. So here's some quick calculations for you guys. Here we're using rent at $2,000 a month. And again, as Corey mentioned earlier, these are round numbers we're using, just trying to make it very simple for you to follow along on the calculations. And we're not going to do any deductions in this, in this scenario, just to keep it very simple. But if you're looking at this, talk to your accountant and find out what deductions you might get in this scenario so that you can really have a good handle on what the scenario looks like for you. So $2,000 a month rent. So you have 2 categories here with financing and if you purchase all in cash. So $24,000 is the annual income. The loan payments here, remember we talked about that, are $6,500 a year. So going straight down the first column, $6,500 a year. You have expenses of and which is just 25% of the rent. So net prior to UDFI is 11,500. Net income subject to UDFI is going to be 6,900. So again, that is percentage directly related to the amount of financing that you do. So if you do 50% financing, 50% of your income is going to be related to the if you borrow 50%, then 50% of your income is going to be exposed to this tax. So keep that in mind. The more financing that you do, the more of your income is going to be related, and also it's going to incur this tax. So net income subject to unrelated debt finance income tax is going to be 6,900. UDFI, if it were 28% and not including deduction and depreciation, would be $1,932. And so that is what ultimately the IRA would pay in this example for this situation for this year. So this year we took out the expenses, so it is going to be the net income here. There's no deductions shown here in this example. And so after all of the calculations done, then the total income minus the taxes would be $9,568. If we look at the all cash purchase example, you're going to see we don't have loan payments that apply here. There's not going to be the UDFI or UBID, the income related to UBID, and there's not going to be a tax paid. And so the all cash purchase income for the year would be $18,000. And so that gives you an idea of really the ability to compare how this works as far as whether or not this is a strategy that you want to look at.
And Larissa, before I jump into my case study here, I saw one question that just popped up right as you finished. May I purchase Roland with my LLC and my IRA as separate titled parcels from one seller? I believe that would be allowed as long as those parcels are identified and the ownership percentage of the original sale transaction are identified, with your LLC taking ownership of a certain parcel based on the dollar amount the LLC is paying, and the IRA taking ownership of the other parcel based on the dollar amount that the IRA is bringing to the closing table. That is a situation, as we mentioned earlier, you're establishing at the outset of the investment the working together, if you will, of the otherwise disqualified entities, being your IRA account and an LLC that you own would otherwise be disqualified, but since they're being brought to the same side of the table at the beginning of the deal, that strategy would work out as long as, again, it's outlined from the outset what parcel is going to which owner, what dollar amount is relative to which parcel, and making sure that owner pays that portion. All right, so my next case study is going to be partnering on a real estate deal. We've got a scenario here where Linda and Paul would like to partner their IRAs together to buy real estate. They each have $100,000. Again, these are round numbers, for example, but just in context of today's webinar, consider if this was Paul maybe having a very minority portion and Linda having a large portion, or vice versa. The dollars matter not, it's the strategy and the concept that we're trying to convey to you guys today. So they find a property that's valued at $150,000 and it's going to need some repair work to get it ready to rent. They estimate once that repair work is done that they're going to generate about $1,500 a month in rental income that'll flow straight into their respective retirement accounts. So they establish the self-direct IRAs if they don't already have them. They find the property, they make the offer to purchase the property in the name of the respective retirement accounts, and they coordinate with their account manager all of the investment paperwork to be filled out and the closing documents in the name of those retirement accounts through the tax ID number of the retirement account, so there's no tax liability for these individuals. And they authorize Advanta to execute the transaction and wire all the funds from the respective accounts to the closing. Once that's done, Advanta receives all the original recorded deed documentation for safekeeping, and we coordinate the income and outgoing expenses from the involved accounts, so Paul and Linda's retirement accounts, and the borrower's or I'm sorry, not borrowers, the tenants of the property or the contractors that are doing work, etc. The deed's going to be titled Advanta IRA for the benefit of Paul and his IRA number as to whatever ownership percentage. So if Paul's money was the down payment money and only putting 20% towards the overall deal, this would say 20% and 80%, vice versa. And again, keep in context, this could be Paul as an individual in Paul's IRA. It could be Paul's IRA and Linda could be Paul's spouse or Paul's daughter using her IRA account. As long as this is all set up at the outset, these are allowable investment strategies that can be flexed based on what your needs are and what the dollar amounts you actually have to bring to the table are as well. So moving forward, just a little bit of maintenance on the property. Similar to the joint venture agreement I discussed earlier, you determine who you want to rent the property to, and you set the tenant agreement. So you negotiate all the terms of the lease. You provide that to Advanta as an authorized and approved item, and we'll execute it and make that legally binding on behalf of your retirement account. And you could also choose to employ a property manager if you'd like a third-party entity to control the cash flow in and cash flow out and just send the residual earnings to your retirement account for a deposit on the back end of things. Repairs and maintenance cannot be done by yourself or a disqualified person. That does not mean you need to hire a licensed and certified plumber or electrician. You can just go to your local handyman that you're familiar with, so long as they are not a disqualified person, and have them do the work. As long as they're invoicing your retirement account or your partnership or your LLC, that payment needs to go out based on those ownership splits that we've covered intensively on today's webinar. But again, no sweat equity from you if your retirement dollars are in the deal. The expenses are paid out of the retirement account or by the property manager or by way of the partnership as that is broken down. And that is basically the gist of real estate investing with partnerships, with non-recourse lending, basically taking your original thought or what brought you to this webinar of using your IRA as a down payment, applying the IRS's rules and regulations, and turning around that strategy into workable, actionable investment opportunities for you. Our key takeaway points for today's webinar is that while you can't technically use the IRA as a down payment, if you're buying a piece of real estate and you just want to put your IRA money up for the down payment side of it, technically that doesn't work, but we've shown you a few ways that this strategy does work to use your IRA as a down payment. Keep in mind, you must keep an arm's length away from the investment. And as we've said multiple times, no sweat equity if your IRA is involved. And as Larissa covered extensively today, using your IRA as a down payment and then financing the rest of the property purchase in the name of your IRA is going to be subject to UDFI tax. Larissa covered how that works. We've let you know that there's other educational content we've put out that goes into more detail on that topic. But these are your key takeaway points from today's webinar. We wanted to make sure we hit home on. We hope we've done so. Larissa, anything else on the key takeaway points? And then I know you wanted to cover the next last few slides to round us home.
No, I think that those are really, truly the most important things that I hope everybody got out of the webinar today. And like I said, if you have more questions on the tax or on different investments that you can make with minimal funds or investing in real estate internationally, as Corey mentioned, we have webinars on all of those topics. So please feel free to reach out to us.
And Larissa, a quick question came up as I advanced the slide for you here. Can the LLC in the name of the IRA handle the payments and expenses of this real estate partnership? Do you want to address that? And then obviously this next slide here.
Yeah, absolutely. So remember that the IRA-owned LLC will be responsible for all the expenses and receive all of the income. That's super important. And then as Corey pointed out earlier, if the IRA is just a partial owner in that LLC, then it's going to be responsible for its share of the expenses. But typically, the LLC is going to alleviate some of that partnership issue where you're saying, okay, well, how much does each partner need to bring to the table for those expenses? Typically, once the money is in the LLC in a partnership scenario, then that money is automatically, or just based on that structure, going to be based on percentage of ownership already, and then the LLC would pay expenses and receive income. If the IRA is the only member of this LLC, so you have checkbook control, then the LLC absolutely will receive the income and pay all of the expenses for that IRA owned asset. So that is definitely a way that people have checkbook control of their retirement account. We do see that scenario a lot. So again, just making sure that it is an IRA owned asset. You're not commingling personal funds into this LLC accidentally, or paying expenses with personal funds accidentally, that the IRA owned LLC is responsible for all the funds in and out of the retirement account via the LLC for the investment property. We have events going on all the time. They're always no cost, no obligation. Usually we have webinars both on Tuesdays and Thursdays every week. And so we would encourage you to join us. We have a lot of great topics coming up. I'm going to be talking about Roth IRAs and Roth conversions and how that works next Tuesday, I believe. I know Corey has another one coming up. What do you have coming up, Corey?
Yep, I've got on the 15th of June, I'm covering hotel investing with Danny Fry of Tempest 22. On the 22nd of June, I'm covering arbitrage rental investing, which is where you don't even own a piece of property and you can use arbitrage, or a way of leasing a property from someone else that owns it, renting the property out, paying your lease plus generating income in the context of how much you're renting that property out from. So those are just my next two upcoming topics. Feel free to check those out. You can find them on advantaira.com/events. You can register for anything like you may have done for today's webinar. And keep in mind, if you register for these webinars and cannot participate with us live, you can always sign up knowing you can't participate live, and you will receive a recording, or you can find them on our YouTube page about 24 hours after the live recording takes place. We also have a blog here if you're interested in some of the industry standard news and some of the legislations going on in the IRA retirement account investing world. Just to bring us home and kind of close out the webinar today, it's really simple if you don't have a self-directed account to get started. Our application takes most people only about 15 to 20 minutes to complete. We will collect the documentation needed from you to get your account funded and started. And typically, most people can set up and fund an account and ready to make their first investment in about 10 to 14 days tops. Given certain circumstances, it may be faster, it may be longer, but a reasonable expectation is about 2 weeks from submitting an application to actually funding your first, whether it be a real estate deal, whether it be lending, any type of loan or investment transaction that you want to do through your retirement account, roughly about 2 weeks from the day you start out until you can fund that transaction. I'll lay our contact information here on the screen for one final minute as we close shop. Thank you so much for participating with us today. It was great participation with the audience and the questions. We love when we're answering your guys' questions and you guys are, taking in the information we're providing, asking us things that are relevant to what we're talking about, and letting us get back to you in real time with the answers relative to our presentation. So keep coming back, keep letting us know if we have other topics you'd like us to cover, and we hope you have a wonderful rest of your day and join us next time. Thank you.
Thank you, Corey.